1. What is the purpose of expansionary monetary policy? Expansionary monetary policy is aimed at stimulating economic growth. This is typically done by a central bank lowering interest rates, which decreases the cost of borrowing. It can also involve increasing the money supply. The goal is to encourage businesses and consumers to borrow and spend more, which should lead to increased production, lower unemployment rates, and overall economic growth too. What is the primary function of financial intermediaries like banks in the financial market? To connect lenders with borrowers. By specializing in certain services, they can offer lower transaction services by creating economies of scale. Financial intermediaries like banks indeed connect lenders, savers, with borrowers. They provide a range of services that can lower transaction costs through economies of scale. Their specialization in assessing credit risk also helps in reducing information asymmetry in the market. 3. How do forward contracts mitigate the risk associated with fluctuations in foreign exchange rates for businesses? Exactly right. Forward contracts allow businesses to lock in a specific exchange rate for a transaction that will occur in the future. This helps businesses to hedge against the risk of adverse currency movements, ensuring that they know exactly what exchange rate they will be transacting at, irrespective of volatility in the foreign exchange markets. 4. What is the primary purpose of a central bank in an economy? Correct again. The central bank, such as the Federal Reserve in the United States or the Bank of Canada, sets the country's monetary policy. It regulates the money supply and interest rates to control inflation, manage employment levels, stabilize the currency, and achieve sustainable economic growth. The central bank's actions can influence the cost of borrowing and saving, thereby affecting overall economic activity. 5. How do interest rates affect consumer behavior in an economy? Low interest rates do typically incentivize borrowing and can stimulate spending in the economy because people and businesses are more likely to take loans for consumption and investment when borrowing costs are cheaper. Conversely, high interest rates tend to encourage saving over spending, as the returns from saving are higher and borrowing costs are more expensive, which can slow down economic activity as consumers and businesses may reduce their spending and investment. 6. What is the significance of the yield curve in financial markets? That's a partial answer. The yield curve is indeed a graphical representation that shows the relationship between interest rates, or yields, of bonds having equal credit quality but differing maturity dates, typically government bonds. Here's a more comprehensive explanation. 1. Indicator of economic health, a normal upward-sloping yield curve, where long-term interest rates are higher than short-term rates, suggests that the economy is expected to grow in the future. Conversely, an inverted yield curve, where short-term rates are higher than long-term rates, is often seen as a predictor of an economic recession. 2. Investor sentiment. The shape of the yield curve reflects investor expectations about future interest rates and economic conditions. A steep yield curve implies that investors expect robust economic growth and higher future inflation, and therefore interest rates, while a flat or inverted curve can indicate expectations of sluggish growth or a potential downturn. 3. Interest rate movements. The yield curve helps investors understand how current long-term and short-term bond yields compare to historical rates, which can influence investment decisions and strategies. 4. Monetary policy decisions. Central banks monitor the yield curve closely as it affects their monetary policy decisions. A flat or inverted yield curve can signal to policymakers that they need to lower interest rates to stimulate the economy. 5. Borrowing costs and investment decisions. The yield curve affects the borrowing costs for both governments and businesses. A steeper curve means higher long-term borrowing costs, potentially discouraging long-term investment. 6. Arbitrage opportunities. For the financial industry, different shapes of the yield curve can create opportunities for profit through arbitrage. 7. What are the potential economic effects of an inverted yield curve? In the land of economica, the central bank faced a challenging predicament. Inflation had been rising steadily, eating away at the purchasing power of the citizens. Prices for everyday items, from bread to gasoline, were climbing higher, causing concern among the people and policymakers alike. To combat this rampant inflation, the central bank decided to take decisive action by raising its key interest rates. This move was intended to cool down the overheated economy by making borrowing more expensive, thus slowing down consumer spending and business investments. As the central bank implemented these higher rates, something interesting began to happen in the bond market. Investors, sensing the central bank's determination to fight inflation, started to expect that these measures would lead to a slowing economy in the near future. Consequently, they became less willing to lock in their money for long periods at the current rates, believing that the central bank's aggressive stance would successfully tamp down inflation and potentially lead to lower rates in the future. This shift in investor sentiment led to a decline in demand for long-term bonds, causing their yields to drop. Meanwhile, the short-term bonds, directly influenced by the central bank's policy, saw their yields increase due to the higher interest rates. The result was an unusual situation where short-term bond yields were higher than long-term bond yields, creating what economists call an inverted yield curve. In economica, this inverted yield curve began to stir discussions and worries. Historically, such an inversion had often been a harbinger of economic recessions. Savvy investors and economists knew that while the central bank's actions were necessary to control inflation, they also increased the risk of an economic slowdown. Businesses, seeing the cost of borrowing rise, might cut back on expansion plans, and consumers, facing higher interest rates on loans and mortgages, might reduce their spending. As the central bank continued to navigate these complex economic waters, the inverted yield curve served as a reminder of the delicate balance that must be struck between controlling inflation and maintaining economic growth. The citizens of Economica watched closely, hoping that the central bank's actions would stabilize prices without plunging the economy into a downturn. Yes, that's a correct understanding. Let's break it down for clarity. 1. Inverse relationship between bond prices and interest rates. In the bond market, there's a fundamental inverse relationship between bond prices and interest rates. When interest rates fall, the prices of existing bonds rise, and vice versa. This is because the fixed interest payments of existing bonds become more attractive when new bonds are issued at lower rates too. Buying long-term bonds during inverted yield curve. When investors buy long-term bonds during a period of an inverted yield curve, they're essentially anticipating that interest rates will decrease in the future. The current long-term bonds yield less because the market expects future rates to be lower. 3. Capital gain expectation, as interest rates decrease, which is what the market often anticipates following an inverted yield curve scenario. The value or price of the long-term bonds that investors currently hold will increase. Investors buying these bonds during the inverted yield curve period are expecting to realize a capital gain. They buy the bonds at a lower price now and can potentially sell them at a higher price later as interest rates fall. 4. Economic outlook. Typically, an inverted yield curve suggests an economic slowdown or recession is on the horizon. In such cases, central banks may lower interest rates to stimulate the economy. Investors who buy long-term bonds before this rate cut can benefit from both the safety of these bonds during economic uncertainty and the potential price appreciation when rates are lowered. So, in summary, the strategy behind buying long-term bonds in an inverted yield curve environment hinges on the expectation of falling interest rates and the subsequent increase in bond prices, providing a potential capital gain opportunity for investors. Certainly. Let's clarify this concept with a more detailed explanation. Fixed interest payments and bond prices. When you purchase a bond, you're essentially buying a stream of fixed interest payments over the life of the bond, known as the bond's coupon payments. The rate of these payments is set when the bond is issued and doesn't change. Scenario: impact of new bonds issued at lower rates. Imagine a situation where existing bonds in the market have a fixed interest rate of 5%. These bonds are paying a steady 5% return each year to their holders. Now, let's say the central bank lowers interest rates due to an economic downturn. As a result, new bonds are issued with a lower interest rate, say 3%. Attractiveness of higher fixed payments. In this environment, the existing bonds with a 5% interest rate become more attractive compared to the new bonds issued at only 3%. This is because they offer a higher return, 5% versus 3%, for a similar level of risk, especially if they are government or high-quality corporate bonds. Market reaction and bond prices. Investors in the bond market, always seeking the best return for their investment, will prefer the older bonds with the higher 5% interest rate. As a result, the demand for these existing higher-yielding bonds increases. Due to this increased demand, the price of these bonds goes up. Remember, the bond's coupon payments are fixed, but the price can fluctuate based on market demand. So now, more people want these 5% bonds, driving up their market price. Conclusion. In essence, the fixed interest payments of existing bonds become more valuable when new bonds are issued at lower rates. This increased value is reflected in the market as higher prices for those existing bonds. So, the core idea is that when interest rates drop, existing bonds with higher fixed interest rates become more desirable in the market, leading to an increase in their price. Questions. How do central banks typically respond to a recession, and what are the intended effects of these responses on the economy? Correct. In response to a recession, central banks typically implement monetary policies to stimulate economic activity. Here's a more detailed explanation. 1. Lowering interest rates. The central bank reduces its key interest rates, making borrowing cheaper. This action is intended to encourage businesses and consumers to take loans for investment and spending, which in turn can help to stimulate economic activity too. Intended effects. Increase in spending and investment. Lower borrowing costs can lead to more spending by consumers on goods and services and more investment by businesses in projects and expansion, boosting confidence. Easing monetary policy can also signal to the market that the central bank is taking action to support the economy, which can boost consumer and business confidence. Influence on asset prices. Lower interest rates can increase the attractiveness of investing in assets like stocks, as returns on savings and bonds decrease. This can lead to a rise in asset prices, increasing wealth and potentially spurring further spending. Currency devaluation. Lower interest rates can also lead to a devaluation of the national currency, which can make exports more competitive and stimulate growth through increased foreign demand. 3. Additional measures. Quantitative easing, QE. In some cases, particularly where interest rates are already very low, central banks may implement QE, which involves the large-scale purchase of government bonds or other financial assets to inject liquidity directly into the economy. Forward guidance. Central banks may also use forward guidance, communicating future monetary policy intentions to influence market expectations and economic decisions. In summary, central banks use these tools to lower the cost of borrowing, encourage spending and investment, and instill confidence in the economy during a recession. The ultimate goal is to stimulate economic growth and mitigate the negative impacts of the recession. What is the liquidity trap, and how does it challenge the effectiveness of monetary policy? Liquidity trap explained. 1. Basic definition. A liquidity trap occurs when interest rates are very low, near zero, and savings rates are high, making monetary policy ineffective. In such a situation, people and businesses hoard cash instead of spending or investing, despite low borrowing costs. 2. Why it happens. This often occurs in periods of economic uncertainty or after a significant economic downturn, where the usual incentives of lower interest rates fail to stimulate borrowing and spending. A key reason is the expectation that economic conditions will worsen, leading to deflation, a general decrease in prices. If people expect prices to fall further, they might delay spending, believing they can buy more for less later. 3. Implications for monetary policy. In a normal situation, central banks lower interest rates to encourage spending and investment. However, in a liquidity trap, even zero or negative interest rates may not be sufficient to boost economic activity. The effectiveness of traditional monetary policy tools is significantly reduced because people prefer to hold on to cash instead of investing in bonds or other assets with minimal or negative returns. 4. Challenges posed. Central banks find it difficult to stimulate the economy through their standard tools. Like rate cuts, it may lead to a prolonged period of stagnant economic growth, low inflation, or deflation. Central banks may have to resort to unconventional monetary policies, like quantitative easing, buying securities to inject money directly into the economy, or implementing fiscal policy measures in collaboration with the government. Example: a classic example of a liquidity trap is Japan in the 1990s and early 2000s, where despite near-zero interest rates, the economy struggled with deflation and stagnant growth, and consumers and businesses continued to save rather than spend or invest. Understanding the concept of a liquidity trap helps in comprehending why sometimes, even aggressive monetary policy actions by central banks might not be enough to stimulate economic growth. Would you like to move on to the next question? Question 1. Why is indirect finance, involving financial intermediaries like banks, more common than direct finance where businesses raise funds directly from lenders in financial markets? Your answer touches on several key points about why indirect finance through financial intermediaries is more common than direct finance. 1. Cost effectiveness and specialization. You're correct in noting that financial intermediaries like banks specialize in the process of raising capital. Their expertise and established systems make it more cost-effective for businesses to obtain financing through them rather than directly from individual investors. This specialization often leads to economies of scale, where intermediaries can operate more efficiently and at a lower cost due to their larger size and volume of transactions. 2. Risk reduction. Intermediaries play a crucial role in reducing risk. They assess and manage the risk associated with lending by performing due diligence on borrowers, which individual lenders may not have the resources or expertise to do effectively. 3. Addressing asymmetric information. Financial intermediaries help to reduce issues related to asymmetric information, where one party in a transaction, typically the borrower, has more or better information than the other, the lender. By evaluating borrowers' creditworthiness and monitoring their activities, intermediaries bridge the information gap, making it safer and more efficient for funds to flow from savers to borrowers. Your response encapsulates the primary reasons why indirect finance is more prevalent than direct finance in financial markets. It highlights the crucial role of financial intermediaries in facilitating the flow of capital in the economy. Question 2. Describe why asymmetric information in financial markets can lead to adverse selection and moral hazard. Your answer captures the essence of how asymmetric information can lead to problems like adverse selection and moral hazard in financial markets. 1. Asymmetric information. Indeed, asymmetric information occurs when one party in a financial transaction has more or better information than the other. This imbalance can lead to inefficiencies and unfair advantages. 2. Adverse selection. Adverse selection happens before a transaction. It occurs when the party with more information, usually the seller or borrower, uses their informational advantage in a way that adversely affects the other party. For example, a borrower with a risky financial profile who knows they are unlikely to repay a loan might still seek financing, but the lender doesn't have this information and may agree to the loan under false pretenses. 3. Moral hazard. Moral hazard, on the other hand, occurs after the transaction has taken place. It refers to the situation where the party with more information, often the borrower, takes undue risks because they know that the negative consequences of these risks will fall more heavily on the other party. For example, a company might take riskier actions after securing a loan, knowing that the lender bears some of the risk of default. 4. Human nature and ethical considerations. Your point about human nature leading to reckless or unethical behavior in these situations is significant. The temptation to exploit informational advantages can lead to decisions that are not in the best interest of the other party or the health of the overall financial system. Your response highlights the critical challenges that asymmetric information poses in financial markets, particularly in lending scenarios. It underscores the need for mechanisms to mitigate these issues, such as thorough credit checks, monitoring, and regulatory oversight. Chapter 11. Financial Crises. Main concept. Understanding the causes and consequences of financial crises. Question 1. What were the primary causes of the global financial crisis of 2007 to 2009? This question aims to explore your understanding of the factors that led to one of the most significant economic downturns in recent history. Once you provide your answer, I'll give feedback. Your answer touches on some critical aspects of the global financial crisis of 2007 to 2009, particularly focusing on asymmetric information and moral hazard in the real estate market. Asymmetric information in real estate market bubble. Indeed, asymmetric information played a role, especially in the subprime mortgage market. Lenders often had more information about the riskiness of the loans they were issuing than the investors who eventually bought these loans in the form of mortgage-backed securities. Moral hazard in bank lending practices. The concept of moral hazard was evident in the practices of many financial institutions. Knowing that their deposits were insured and that they might be bailed out due to being too big to fail, banks and other lenders issued increasingly risky loans. They believed that they would not bear the full brunt of the potential losses from these loans. Additional factors that contributed to the crisis include securitization of subprime mortgages. Banks bundled risky loans into securities, which were then sold to investors who underestimated the risk due to the perceived high ratings of these securities. Collapse of housing bubble. The crisis was precipitated by the bursting of the housing bubble, which led to a sharp decline in home prices and a rise in loan defaults and foreclosures. Inadequate regulation and oversight. There was a lack of effective regulation and oversight in the financial sector, particularly concerning new financial instruments like derivatives. Your response captures some of the crucial elements that led to the global financial crisis, emphasizing the significant impact of asymmetric information and moral hazard in the banking sector. Your answer touches on some critical aspects of the global financial crisis of 2007 to 2009, particularly focusing on asymmetric information and moral hazard in the real estate market. 1. Asymmetric information in real estate market bubble. Indeed, asymmetric information played a role, especially in the subprime mortgage market. Lenders often had more information about the riskiness of the loans they were issuing than the investors who eventually bought these loans in the form of mortgage-backed securities. 2. Moral hazard in bank lending practices. The concept of moral hazard was evident in the practices of many financial institutions. Knowing that their deposits were insured and that they might be bailed out due to being too big to fail, banks and other lenders issued increasingly risky loans. They believed that they would not bear the full brunt of the potential losses from these loans. Additional factors that contributed to the crisis include securitization of subprime mortgages. Banks bundled risky loans into securities, which were then sold to investors who underestimated the risk due to the perceived high ratings of these securities. Collapse of housing bubble. The crisis was precipitated by the bursting of the housing bubble, which led to a sharp decline in home prices and a rise in loan defaults and foreclosures. Inadequate regulation and oversight. There was a lack of effective regulation and oversight in the financial sector, particularly concerning new financial instruments like derivatives. Your response captures some of the crucial elements that led to the global financial crisis, emphasizing the significant impact of asymmetric information and moral hazard in the banking sector. Chapter 11. Financial Crises Main Concept. Responses to Financial Crises. Question 2. How did central banks and governments around the world respond to the global financial crisis of 2007 to 2009? This question explores the various measures and policies implemented to address and mitigate the effects of the crisis. Once you provide your answer, I'll offer feedback. 1. Bailout of financial institutions. Indeed, one of the most significant responses was the bailout of major banks and financial institutions. Governments, particularly in the United States, injected capital into banks and bought troubled assets to prevent a complete collapse of the financial system. This action was based on the belief that the failure of these institutions would have catastrophic effects on the global economy. 2. Lowering interest rates. Central banks around the world, including the US Federal Reserve, the European Central Bank, and others, drastically reduced interest rates to historic lows. The idea was to make borrowing cheaper, encourage spending and investment, and stimulate the struggling economy. Additional responses included quantitative easing. Central banks, Notably, the Federal Reserve implemented quantitative easing (QE) programs. QE involves the central bank purchasing government securities or other securities from the market to increase the money supply and encourage lending and investment. Regulatory reforms. Post-crisis, there were significant regulatory changes aimed at preventing a similar crisis. These included increased capital requirements for banks, stricter oversight of financial institutions, and new rules for mortgage lending and securitization. Fiscal stimulus. Many governments implemented fiscal stimulus measures, including increased public spending and tax cuts, to boost economic growth and mitigate the impact of the recession on employment and GDP. Your response correctly highlights the immediate actions taken by central banks and governments, focusing on bailouts and interest rate cuts, which were crucial in stabilizing the financial system and laying the groundwork for economic recovery. Chapter 13. Financial derivatives. Main concept. Understanding the function and use of derivatives. Question 1. What are the differences between a forward contract and a futures contract? This question aims to test your understanding of two fundamental types of financial derivatives and how they differ from each other. After you provide your answer, I'll offer feedback. 1. Trading platform. Forward contracts. You correctly noted that forward contracts are traded over the counter, OTC, and not on an exchange. This means they are negotiated directly between two parties. Futures contracts, in contrast, futures contracts are traded on standardized exchanges. This standardization facilitates broader market participation and liquidity. 2. Customization. Forward contracts. You rightly pointed out that forward contracts can be tailored to the specific needs and preferences of the contracting parties. This customization allows for greater flexibility in terms of contract size, asset type, and delivery date. Futures contracts. Futures contracts are standardized in terms of their contract size, expiration dates, and the underlying asset. This standardization limits flexibility but ensures that contracts are easily tradable and fungible. 3. Risk and regulation. Forward contracts. Due to their private and customized nature, forward contracts carry a higher degree of counterparty risk, the risk that one party may not fulfill their obligations. Futures contracts. Futures are cleared through a clearinghouse associated with the exchange, which mitigates counterparty risk. The daily settlement and margin requirements also manage the risk. Let's move on to the second question from Chapter 13. Question 2. How do options contracts provide flexibility in investment strategies compared to other derivative types? 1. Right but not obligation. You correctly noted that options contracts give the buyer the right, but not the obligation, to buy, call option, or sell, put option, an underlying asset at a predetermined price, known as the strike price. This is a fundamental feature of options that provides flexibility to call and put options. Call options. The buyer of a call option has the right to buy the underlying asset at the strike price. This option becomes profitable if the market price of the asset rises above the strike price. Put options. The buyer of a put option has the right to sell the underlying asset at the strike price. This option is advantageous if the market price falls below the strike price. 3. Premium. You accurately mentioned that buying an option requires paying a premium. This premium is the cost of acquiring the option and is the maximum loss the buyer can incur if they choose not to exercise the option or if the option ends up being out of the money, not profitable. 4. Flexibility and risk management. Options allow investors to speculate on both the upward and downward movement of asset prices with limited risk, limited to the premium paid. They also provide opportunities for various strategies like hedging against price movements, generating income through selling options, and leveraging positions in the underlying asset. 5. Seller's perspective. It's important to note that the seller, writer, of the option has an obligation to buy or sell the underlying asset if the buyer exercises the option. This comes with its own risk and return profile, different from that of the buyer. Your response underscores the flexibility that options offer in investment strategies, particularly in terms of risk management and the ability to speculate on price movements with a known and limited downside. The tale of two traders, Alex the buyer and Sam the seller. In the bustling world of Wall Street, two traders, Alex and Sam, decided to delve into the world of options trading, each from different perspectives. Alex the buyer, the seeker of opportunities. Alex was an optimistic trader, always on the lookout for opportunities. He believed that Tech Boom, a rising tech company, was about to skyrocket in the stock market. However, Alex was also cautious and didn't want to risk too much capital. So, he decided to buy a call option for Tech Boom shares, his right, not obligation. By paying a premium, Alex secured the right to buy Tech Boom shares at a set price, strike price. In the future, he thought, if Tech Boom's stock price soars, I can buy shares at this lower price and make a good profit. If it doesn't, I'll just let the option expire. My loss will only be the premium. Waiting for the moment, over the next few weeks, Alex watched Tech Boom's stock performance eagerly, ready to exercise his option if the stock price went up significantly. Sam the seller, the collector of premiums. Meanwhile, Sam, a more conservative trader, was looking for a steady income stream. He didn't expect Tech Boom's stock to rise much and decided to write, sell, call options for Tech Boom, becoming the counterparty to buyers like Alex collecting the premium. Sam collected the premium from Alex, thinking, this premium is mine to keep. It's a nice way to earn some income, the obligation he signed up for. But Sam knew he had an obligation. If Tech Boom's stock price rose above the strike price, he'd have to sell the shares at that lower price, potentially missing out on higher profits or even incurring a loss. Risk management. Sam kept a close eye on the market. He knew he might need to buy Tech Boom shares to cover his position if the stock's price started climbing too high. I have to be ready, Sam thought, to manage any risks that come with my obligation. The markets twisted as the weeks passed. Tech Boom announced groundbreaking innovations, and its stock price began to soar. Alex was ecstatic. It's time to exercise my option, he exclaimed. He purchased Tech Boom shares at the strike price, far below the current market price, and sold them for a handsome profit. Sam, watching the same news, realized he had to fulfill his obligation. He sold Tech Boom shares to Alex at the agreed upon, now lower, strike price. Well, I did make money from the premium, Sam reflected, but I also learned a valuable lesson about the risks of selling options. Covering his position, to mitigate the risk, Sam contemplated buying Tech Boom shares himself while they were still relatively low in price. This strategy, known in trading as establishing a covered call, would mean that if Alex decided to exercise the option, Sam could fulfill his obligation using these shares without having to purchase them at a much higher price later. The balancing act. Sam knew this approach required a delicate balance. Buying shares to cover his position meant investing more capital and thus increasing his exposure to Tech Boom's stock performance. However, it also meant reducing the risk of significant losses if the stock price rose too high. Epilogue. Alex and Sam's foray into options trading taught them both valuable lessons. Alex learned the power of options to capitalize on market movements with limited risk. Sam learned about the balance of earning premiums and the responsibility and risks that come with writing options. Chapter 18, Foreign Exchange Rates. Main concept, understanding the dynamics of foreign exchange markets. Question 1. What are the primary factors that influence exchange rates in the short term? This question aims to examine your understanding of the factors that cause fluctuations in exchange rates over shorter periods. Example in a story form, imagine a country, let's call it Econoland, which unexpectedly raises its interest rates. Investors around the world see this and think, Econoland's banks now offer higher returns on deposits, so they start buying more of Econoland's currency to take advantage of these higher rates. This increased demand for Econoland's currency causes its value to rise against other currencies. Meanwhile, Econoland releases a report showing its economy is growing faster than expected. This news further boosts investor confidence, and more investors flock to buy Econoland's currency, strengthening it even more. However, a sudden political scandal in Econoland makes investors nervous. They start selling off Econoland's currency because they fear the scandal might lead to economic instability. This selling pressure causes the currency to weaken. This scenario demonstrates how interest rates, economic data, political events, and market sentiment can all have immediate and significant impacts on exchange rates. Chapter 18, Foreign Exchange Rates. Main concept, The role of central banks in foreign exchange markets. Question 2. How do central bank policies impact exchange rates? This question aims to explore your understanding of the influence that central banks exert on exchange rates through their monetary policies. Once you've provided your answer, I'll offer feedback. 1. Monetary policy and money supply. Central banks control the national money supply through various monetary policy tools. By increasing the money supply, expansionary policy, a central bank can cause its currency to weaken because more currency units are available. Conversely, reducing the money supply, contractionary policy, can lead to a strengthening of the currency, as fewer currency units are in circulation. 2. Interest rate adjustments. Central banks influence exchange rates significantly through setting key interest rates. When a central bank raises interest rates, it generally leads to a strengthening of the national currency. Higher interest rates make the currency more attractive to foreign investors seeking higher returns on deposits and investments. Lower interest rates can have the opposite effect, potentially weakening the currency as they make returns on investments in that currency less attractive. Additional factors. 3. Market expectations. The expectations of investors regarding future central bank actions can also affect exchange rates. If investors anticipate that a central bank will raise interest rates in the future, they might start buying the currency in advance, leading to an appreciation. 4. Central bank communications. The way central banks communicate their policies and intentions can influence market sentiments and expectations, thereby impacting exchange rates. Clear guidance on future policy actions can stabilize currency movements, while ambiguity can lead to volatility. 5. Intervention in forex markets. In some cases, central banks may directly intervene in the foreign exchange market to influence their currency's value, buying or selling large amounts of currency to adjust the exchange rate to a desired level. Your response effectively encapsulates the primary ways through which central banks can influence exchange rates via their monetary policy actions. Chapter 26. Transmission mechanisms of monetary policy. Main concept. How monetary policy affects the economy. Question 1. Describe the traditional interest rate channel of monetary policy transmission and how it affects economic activity. This question is aimed at understanding how changes in interest rates, as part of a central bank's monetary policy, influence the broader economy. After you respond, I'll provide feedback. The traditional interest rate channel of monetary policy. 1. The concept of a channel. In monetary policy, a channel refers to the pathway through which policy decisions like changes in interest rates affect the real economy, like consumer spending, investment, and overall economic growth. The traditional interest rate channel is one of the primary means through which central banks' policy decisions are transmitted to the broader economy. 2. Functioning of the traditional interest rate channel. When a central bank changes its key interest rates, it directly influences short-term interest rates and indirectly affects long-term rates. Lower interest rates make borrowing cheaper, encouraging businesses to invest and consumers to spend more. This leads to increased economic activity, which can stimulate growth, especially in an expansionary monetary policy scenario. Conversely, higher interest rates make borrowing more expensive, which can cool down an overheated economy by reducing spending and investment. This is often seen in a contractionary monetary policy setting. 3. Impact on economic decisions. The interest rate changes impact a wide range of economic decisions. For instance, lower rates can boost housing markets due to cheaper mortgages, while higher rates can dampen housing demand. Businesses may decide to expand or initiate new projects when borrowing costs are low, while they might scale back during times of high interest rates. 4. Lag effect. As you mentioned, the effects of changes in interest rates are not immediate. This is known as the lag effect. Economic agents take time to adjust their plans and actions in response to changing monetary conditions. Policymakers must be cautious with the timing and magnitude of interest rate changes due to this delayed impact on the economy. 5. Long-term repercussions. Decisions made by central banks can have long-lasting effects on the economy. For example, keeping interest rates too low for too long might lead to inflationary pressures, while keeping them too high might stifle economic growth. Conclusion: the traditional interest rate channel is a crucial mechanism in monetary policy, influencing economic activity by affecting the cost of borrowing. Central banks wield this tool with an understanding of its potent impact on various economic sectors and the time it takes for these impacts to materialize fully. Chapter 26: Transmission Mechanisms of Monetary Policy. Main concept: Credit view of monetary policy transmission. Question 2: What is the credit view of monetary policy transmission, and how does it differ from the traditional interest rate channel? This question aims to explore your understanding of the credit view as an alternative mechanism through which monetary policy affects the economy, contrasting it with the traditional interest rate channel. After you respond, I'll provide feedback. The credit view of monetary policy transmission. 1. Beyond interest rates. The credit view suggests that monetary policy affects the economy not only through changes in interest rates but also by directly influencing the availability of credit. It emphasizes the role of banks and other financial intermediaries in the transmission of monetary policy to the real economy. 2. Bank lending channel. One key aspect of the credit view is the bank lending channel. When a central bank changes its policy rate, it affects the amount of reserves banks hold, which in turn influences their ability to lend. For example, if the central bank lowers interest rates, it often increases the reserves in the banking system, making it easier for banks to lend. Conversely, raising rates can tighten the credit by reducing bank reserves. 3. Balance sheet channel. Another aspect is the balance sheet channel. Monetary policy changes can affect the net worth of businesses and consumers, which in turn influences their ability to borrow and spend. For instance, lower interest rates can lead to higher asset prices, like real estate or stocks, improving the balance sheets of companies and individuals, making it easier for them to get loans. Contrast with the traditional interest rate channel. 1. Focus on interest rates. In the traditional channel, the traditional interest rate channel mainly focuses on how changes in interest rates influence consumer and business behavior. Lower rates make loans cheaper and encourage borrowing and spending, while higher rates do the opposite. 2. Inclusion of credit factors in the credit view. The credit view adds an additional layer to this understanding by considering how changes in monetary policy directly affect the lending capacity of banks and the creditworthiness of borrowers, beyond just the cost of borrowing. 3. Broader economic impact. While the traditional channel is primarily about the cost of credit, interest rates, the credit view looks at the availability and conditions of credit in the economy, acknowledging that even if credit is cheap, it might not be readily available due to other constraints. Conclusion: the credit view of monetary policy transmission provides a broader perspective on how monetary policy affects the economy. It highlights the importance of credit availability and conditions, alongside interest rates, in influencing economic activities. Chapter 8: Study Guide. Understanding Financial Markets. Common features of advanced financial markets. 1. Indirect finance. More prevalent than direct finance, with financial intermediaries such as banks channeling funds from savers to borrowers. Example: a retail investor's savings are managed by a mutual fund, which invests in a diversified portfolio of assets. 2. Intermediation by savers and borrowers. Savers and borrowers typically prefer to use intermediaries to facilitate transactions due to their expertise and ability to spread out risk. Example: a startup secures funding through a venture capital firm, leveraging the firm's ability to assess and manage startup risks. 3. Regulation of financial markets. These markets are subject to stringent regulations to promote transparency, reduce risk, and protect participants. Example: the Basel III regulations in banking set minimum capital requirements and introduce liquidity standards. Problems in financial markets. 1. Transaction costs. High costs can deter trading and decrease market efficiency. Example: the spread between bid and ask prices on stock exchanges represents a cost for traders. 2. Asymmetric information occurs when one party has more or better information than the other, leading to adverse selection and moral hazard. Example: an insurance company faces the risk of policyholders having more information about their health risks. Adverse selection. Example: a bank faces adverse selection if borrowers with a high default risk are more likely to apply for loans. Moral hazard. Example: after receiving a loan, a company may engage in riskier projects than what was agreed upon, potentially endangering the repayment of the loan. Tools to manage asymmetric information for adverse selection, private production and sale of information, for example, credit rating agencies assessing the creditworthiness of borrowers. Government regulations to increase transparency, for example, SEC regulations requiring public companies to disclose financial information. Financial intermediation, for example, banks performing due diligence before extending credit. Collateral and net worth, for example, secured loans requiring assets as collateral. For moral hazard production of information monitoring, for example, auditors checking company accounts regularly. Financial intermediation, for example, banks monitoring the financial health of loan recipients' net worth and collateral. For example, high net worth individuals providing personal guarantees for loans. Restrictive covenants in debt contracts, for example, covenants limiting the amount of additional debt a company can incur. Adverse selection, the lemon problem. Example, in a used car market with both high quality, peaches, and low quality, lemons, cars, if quality is not observable, the market price will reflect an average, driving out high quality cars and leaving only lemons. Solutions to adverse selection in markets. Providing full disclosure of car conditions or certification programs can help buyers ascertain the quality of the cars. Equity and bond markets concerns equity markets. The issue of asymmetric information can affect stock prices if insiders act on private information. Bond markets, the risk that bond issuers may engage in activities that deteriorate the value of bonds without the bondholder's knowledge. By understanding these principles, the study guide helps to grasp the functions of financial markets, the significance of intermediaries, and the critical role of regulations. It also outlines how financial systems are designed to promote economic efficiency and manage informational challenges affecting economic performance. The bond market, also known as the debt, credit, or fixed income market, is a financial market where participants can issue new debt in the primary market or buy and sell debt securities in the secondary market. This market is where government entities, municipalities, corporations, and other institutions can obtain funding for various purposes such as financing projects, operations, or expansions. Bond market, participants, issuers, governments, companies, and financial institutions needing to raise funds. Investors, retail investors, institutional investors, and sovereign funds purchasing bonds to earn interest income with a relatively low level of risk. Intermediaries, banks and brokers facilitating the trading of bonds. Types of bonds: government bonds, issued by national governments, considered low-risk investments. Municipal bonds, issued by states, cities, or counties, often with tax benefits. Corporate bonds, issued by companies, riskier than government bonds but usually offer higher yields. Supranational bonds, issued by organizations like the World Bank. Bond yield curve. The bond yield curve is a graph showing the interest rates on bonds at different maturities. It reflects the relationship between a bond's yield and its time to maturity and is widely used as an economic indicator. Types of yield.